Hi traders, in this video we're going to go over number 1, how we mark off and combine candlesticks, number 2, why we do this to simplify our charts, number 3, why this can affect marking off the highs and the lows on your chart. We've already covered this to some degree, but I wanted to go over and give a few more examples to clear up this subject. So we're talking about marking off candlesticks and encompassing candlesticks here. So we'll start with this green candlestick right here. And what we want to do is we want to take the high and the low of this candlestick and extend it forward all the way until it reaches a candlestick in which breaks both its high or its low, either its high or its low. So what we're doing here is we're taking this single candlestick and we're encompassing any bars either prior or post of it to give us a clearer visual representation of what's happening in the market towards the highs and lows. Now, this isn't saying that the candlesticks that happened here are irrelevant, but when we're marking off the highs and the lows, we have to take a look at these larger candlesticks that encompass ones in front of or behind them with a little bit more weight, because every candlestick past this large green one until its high or low is broken is in some ways less significant in our eyes, because all of the market activity up, down, sideways happened within this period. So we're looking at a 60-minute chart right here. So 2 hours past this large green candlestick, 2 candlesticks, were fairly irrelevant because they weren't able to push higher highs or lower lows. And so with this marking off, it gives us a better understanding and a cleaner view on exactly what's happening in the market. So let's look for the next one. So we go forward until we find a candlestick that encompasses, we go from top to bottom, 1, 2, 3, and the fourth one breaks it. So we see in this already 2 examples of one candlestick that encompasses 2, and the second red candlestick here, this down candlestick, that encompasses 1, 2, 3, 4, including itself. Now, why wouldn't we consider this green candlestick encompassing? Well, if we just take a quick look, and you'll get an eye for this, its high going forward, its low going forward is immediately broken by this red one, and its low is also broken prior to this. So we can't consider this an encompassing candlestick. It's just one candlestick by itself, and quite an important one because it was a high in this area. So let's move forward and mark off the next one. So again, we see we have one that goes from here and encompasses multiple candlesticks right here. So this one encompasses 1, 2, 3, 4, 5, 6 candlesticks encompassing. And so this is helping us compress our charts down. Let's keep moving forward and mark off the encompassing candlesticks. Test. We go up to this one. Nope, broken. So this one just encompasses one other candlestick. But the one following that, we can see encompasses this up candlestick right here. Moving forward, again, we have 1, 2, 3 that don't encompass as their highs are broken after they were made. But what we have here is a even larger candlestick that when we take a look at it, we take the high, we take the low, and we move it back until we see its high and low are broken. And you can see that this one green candlestick, this one up candlestick, actually almost broke all of this highs here. So when we're taking a look, all the trading activity that happened within this one single candlestick was enough to overshadow almost overshadowed this area right here. So we have to say there was a lot of volatility in this candlestick, and therefore that volatility kind of encompasses the ones prior. If the market's not moving much, but then you get a very large market movement, all of the market movement prior to it becomes encompassed very often. Moving forward, we see an example here to here, encompasses 1. We see this one is broken, but that this candlestick encompasses the one past it. Highs are broken, the market moves up. We get another one right here. And I'm just going to quickly mark off the rest in this chart. Okay, so what we've done is we've actually marked off all of the encompassing bars on this chart, and you can see there's quite a few. I recommend you do this on a chart to get a better feel for it. So when we take a step back, we're able to see a little bit more clearly exactly what's happening on these areas when we take, instead of considering each of these bars and looking at them and analyzing them, we're able to take them and compress them down to what would be a single bar, giving us a clear example of higher highs and higher lows. This goes in what I was saying about how this can affect marking off the highs and the lows. So when we're looking at it here, on an area like this, when we're looking at marking off a high, so we're going to be marking off a high here, coming off of a low right here. It's easy for us to possibly in this area right here to get a little bit confused because the market does go up, does go down, but we're just going to ignore that because all of this is encompassed by one single bar in this entire area, namely being this bar. This bar right here encompasses all of the data, all the information in this set of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 bars. Now this was an overnight session, so that even helps us because in the overnight session there we had compression in the market. The market didn't really move much. There wasn't much volatility. So we take this one single bar, it encompasses all these, and it gives us a clear representation when we get our next low. And then when we get our high after that, where we can, looking back to the strategy, we're not going to go into that strategy as we've gone over it at length in a video, where we have a lower high here. As the market comes down, what might be confusing if we were doing the lower highs and lower lows strategy would be in this area right here. So we have this lower high made, we have the lower low made right here, and then we see the market dip and then pop back up. So if we weren't doing this marking off of significant bars or encompassing bars, we would think, oh, mark this as a low and then this is a high. The reason we don't do that is because this single bar, this one red candlestick, encompasses all of this low and then high movement. So we're not going to take this into consideration. We're going to pay attention to this. Don't get me wrong. I mean, there's still valid information there. We're marking off the highs and the lows. Highs and lows are going for significant points of support and resistance. So if these 2 points, these two little miniature highs and lows happen within this one candlestick, they're not significant. We're going for significant. We want to wait until the market breaks a lower low here, and we see that when that happens, and that's extremely good that we see that. All right, we're continuing on, and then again here we have this one candlestick right here encompass all of this area. And what do? Well, if we compress it back down, this will be our high. Because this candlestick, even though there's a lot of things happen in this area and here, this top here, or looking at this particular candlestick, is our high here. So what do we have? Oh, we have a lower high, which is exactly what we're looking for in this particular candlestick analysis pattern. Now, we can pop and do this on another chart. We can even do this on a daily chart where we're looking for if possibly all of an entire day or multiple days trading activity was all encompassed within one candlestick. So we see our first example right in the middle of the chart here, where we had one high-ranging day that ended up taking over 1, 2, 3, 4, 5, 6 days. It encompassed 6 days that didn't break either the high or the low of one single candlestick. And that's quite significant. That means that all of the activity that happened in this one green candlestick here was encompassing of all the bars past it. Take a look. See another minor one right here. You can see the hard right edge is already broken below the previous day, so that's not going to count. We see this happening, and you'll see these days when you drill down into them where they're just not overly, they might make attempts at these highs, but they just don't have the conviction to break through these previous levels. See another one on the way down here. We take a look at this one, but no, its bottom was broken, so it's not encompassing. See, this encompasses the one prior. This encompasses the one prior as well. And this one encompasses quite a few. This encompasses multiple bars, multiple candlesticks here. So 1, 2, 3, 4, 5, 6, 7. So we can kind of condense that and say, okay, that's one single candlestick when we're looking at it from this particular viewpoint. And I know a lot of trades are made during that area. You can even trade within these areas. It's not to say you can't trade in them. What we're doing is we're really paying attention to basically these high-ranging bars that encompasses multiple candlesticks prior or post, trying to make it a little bit clearer for us when we're marking off the highs and the lows in our strategy. And we're looking for the highs and the lows in the chart. So again, another one that encompasses only 2 prior. And you can go backwards in your chart to do this, or forwards. And it's not something you have to do new on every chart. You know, once you mark this off, you can leave this on your chart and you can see a very clear outline of the highs and lows when you combine these candlesticks to give you a better idea of what's actually happening. You know, we're getting these high-ranging bars and then trading after that. Well, the trading after that just doesn't have the same level of impact. If something huge was able to happen within one day, a large price movement was able to happen within one day, well, then that one day its levels, its high and its low will be quite significant, but all of the levels in between. So if we're looking at this green candlestick, its high and low was fairly decent. It had quite a high and quite a low. And what it was able to do is it was able to basically take all of the trading that happened on the next day even less, the day after that, and the day after that, and the day after that. And all of the up and down price movement happened within one single day of all of these days. So that one single day ends up being weighted a little bit more, especially when we're marking off the highs and the lows in the chart. I hope this gave you a better understanding of marking off encompassing bars and why we do this to simplify our trading down to bars that actually are wide-ranging and not the ones that are kind of bouncing back and forth in the market post or prior to them.
Do you have any trading topics that you'd like covered? Leave a comment below and we can dive deeper into all things trading.